This is Gerardo Del Real with The Outsider Club. Joining me today is economic geologist and co-editor of one of the best newsletters in the junior resource space. That's true, Mr. Joe Mazumdar. Joe, thank you for joining me this evening.
Thank you, Gerardo. Thank you for having me again.
You just moderated a precious metals panel. You covered several topics. One that's been getting a lot of traction lately is jurisdictional risk. I want to start out by asking about the sentiment here at the conference, and then I'd love to pivot and get your take on how important it is to vet that out prior to speculating or investing in what's obviously a high risk, high reward space, right?
Yeah, I would say, like, in the panel, we had a good cross section of the representation of the people that are putting money into the sector. Institutional, active funds, institutional passive. We had retail, and then also private equity. So we had a good cross section of what people are looking at, and so you can go all the way from the institutional equity side. That's looking at bigger companies, mid-tier, but what was interesting about what Joe Foster of the portfolio manager for Van Eck was saying, that he was more into the mid-tiers and developments, and he wasn't really into the majors. So that was interesting for me. And then with respect to private equity, they mentioned, like obviously with Van Eck, they're focused on gold, but they were focused not only on gold with private equity, but copper, nickel, and zinc in terms of the base metals. So those are the commodities they're keen on. And then with retail, it was mostly about discovery. Get that discovery hole, and then geopolitical risk matters less because asset in the end trumps geopolitical risk, if you can find the best project.
And let me stop you there, because you asked a great question, and I want to ask you the exact same question. Would you prefer a great asset in a bad jurisdiction that you could manage, or would you prefer an earlier stage asset in a jurisdiction where the company's got control and can minimize that risk? Okay,
so from our perspective, I guess we go where the demand is. So if we see, like our exit strategy is not unlike Steve Todoruk's at Sprott Global, that he would like to vet the asset to the point that this is an asset that's got to get taken out. Okay? So hopefully, a better jurisdiction gets you more people, more eyes on it, and a better bid. Less people, less eyes on it, so a worse bid and potentially a single bid. But in the end, if you find that asset, it's going to get taken out. So you get that level of confidence in terms of the risk. Your underlying risk, you have an asymmetric risk profile because you found that quality asset and it is good. And so everything else is about geopolitical risk or something like that, but somebody's going to want that. I don't know who, but somebody's going to want that. And so asset usually is our main focus. And then, but if people aren't going to be, meaning companies, industry, are going to stay away from a jurisdiction, there's no reason for us to be there, because then they have to develop them themselves, and then they'll have all the hassles of development, and then have all the hassles of financing, which could be dilutive because they know that they don't have very many avenues to finance. So yes, for us, geopolitical risk is important, but we look at it from the perspective of, is it important for the potential suitors? If it's important for them, then it's important to us. If it's not, then it's not. But what we've seen is, in terms of the assets being acquired and where we've seen the industry private placements, have been definitely for lower geopolitical risk jurisdictions.
Are there jurisdictions that, in your eyes, have improved recently?
Improved in terms of, in terms of, for exploration, let's just say, exploration stage, like someplace like Chile that's known for being very geopolitically stable, and that wasn't getting a lot of exploration money into it because it was a problematic land situation and it was hard to pick up ground, and that's been changing. And so when you take that level of bureaucracy and the inability to secure tenure, and then you take that out, and then you have one of the most prospective belts for copper and also gold, in South America within a very small country, and then layer on the fact that in South America it's one of the most geopolitically stable jurisdictions. We've seen an uptick in people looking for assets there, and juniors exploring there. And, another theme here was the amount of Australians that are coming into this market, attending these shows, but also acquiring assets. So we saw a company like, I think it was Northern Star acquire Pogo. And it was a very accretive transaction, and it was their first foray, I believe, into North America. So we've just added a new potential menu of suitors for assets in North America and potentially South America, the Americas, that we haven't seen in a while.
How do you gauge the retail appetite?
Well, if I go by the retail appetite, like I was talking to Steve Todorovic from Sprott, I mean, he hasn't seen much of an impact on what he's done, but he's been doing it for a long time, and he's got a very stable platform of clients. But he's been seeing more companies come in, some hedge funds come in and use him. What we've seen is since 2017, we've tracked about 25 companies. And, we talk about those drill intersections. Is this a discovery, and what could that do? And really, that's what the retail audience is interested in. They're not less interested in development, not interested in stable production. They really want that, hey, this is a penny stock. It could go to $1, whatever. Triple baggers, 5 baggers, 10 baggers. And so what we've seen is 25 companies from 2017 to now generated an average return of over 500% in 2 days. And we've seen that, just recently with a couple of other companies, but up to a return of 4,000%. Okay, but if the next hole doesn't deliver or something else happens, then we've seen them on average go down about 50% over the next 10 days, up to down 97%. So really it's about, doing the due diligence, finding if that's actually a drill hole that makes sense. And that's the work we do. So when we see a drill hole intersection and the stock goes nuts, then we get our subscribers asking us, well, is this good? Is it legitimate? And then we look at it and we say, well, it looks like they re-drilled an old hole, or looks like that intersection isn't actually that long. And so it's much shorter, higher grade, mind you, but since it's shorter, the continuity from one hole to the other is not going to be very good. So that's how we basically talk to our subscribers about that. But when we do find one that hit that hole that we like, and we think, oh my God, this has totally changed it. And I'm not going to name the company, but there was this one company in northern BC. I mean, I'd looked at it before. It had a gold project. I wasn't that keen on the gold project. But then they drilled a deep hole and looking for a potential porphyry, which they sort of skinned the year before. And then they drilled right down it, and then they were getting grades equivalent to the grades of a mine nearby. And then I thought, yes, this is what we're looking for, because we've seen a lot of assets, copper-rich assets being acquired. In northern BC and BC in general, good jurisdiction for people. Galore, 50% Newmont went in, and that was a copper-gold project in British Columbia. So I've seen some of these companies, if you look at Newmont specifically, that have assets expropriated, slowly, but surely, in Indonesia, and which was a measured expropriation, mind you, divestment, let's call it. And then they lost those reserves from a big copper gold porphyry in Batu Hijau in Indonesia. And then also because of social license to operate issues and local opposition to the project in Conga, they lost that as well. So that was a significant amount of copper and gold reserves that they lost. And so their next acquisition for a copper gold asset, they were probably thinking that we don't want to take on that geopolitical risk if we're going to add reserves, because Galore Creek had reserves. So we're definitely focused on, hey, does this make sense? And wow, here's an asset right by it that's operating, that's very important for this company. I'm not saying that's the company that could acquire this one, but I know that there are a lot of companies in BC looking for these porphyries, and there's a certain grade that works. And those guys were hitting that grade in that hole, and now we need that to continue.
Fantastic. Let's talk about gold a bit. Bearish sentiment, record short positions in the futures space. What's the next catalyst? That was another question that was presented during the panel there. What do you see as a potential catalyst, or do you think we have another leg down in the precious metal space.
Yeah, so H1, 18, World Gold Council gold demand was weak and probably the worst it's been, I believe, since 2006. Gold's down about 7%, but now it's sort of going sideways. And so we're looking at, potentially down to 1180, potentially up to 1220, but it's basically sideways. And the point is, right now, people aren't looking for safe haven assets. And also during this interim when we've had issues, gold hasn't outperformed as a safe haven asset either. So there's not a lot of love for gold. Equities is where everybody wants to be. The economy in the US is running very well, and they don't see any value in holding gold. What's going to change that is, so if we've got a theme that, hey, the uncertainty in the U.S. economy heightens. Maybe these global tariffs come back to bite them. Maybe that forces inflation if China doesn't change its currency. So they drive the inflation right back to the U.S. consumer. Do we get a change like now that as Joe Foster was saying, as we keep ratcheting up rates, is a lot of this spending based on debt financing, and if it is, then that's going to be eventually cut off. And so is that driving the economy? And if you turn that tap off, what happens then? So U.S. equities are at all-time highs, but we've been saying that for 3 to 4 years. So how much higher can they go? So as soon as we introduce more risk, whatever it is, into that market, especially into the equity market, and then people need to diversify, then we'll see an uptick in gold. And then, like Joe Foster was saying, then we'll see the generalists come back into the gold sector. But right now, as we were talking, people are not investing. We've seen outflows, obviously, not only from the ETFs, but in terms of the actively managed funds. So we've seen like maybe $500 million a year going from these actively managed funds. And there was a CIBC report basically also saying that the actively managed funds are, and that's where companies go to look for equity financing, have gone from being about 2/3 of the over $50 billion of assets under management to around, I'm not sure, 85 to 90% of half the number. So their influence has shrunk quite a bit, but what's taken advantage of that has been inflows into ETFs. So a lot more money has gone into ETFs now.
We've seen private capital, the so-called smart money, come into the space recently with some M&A transactions. Do you see more of that in this depressed market?
Yeah, I don't know what smart money means anymore, but I would say that the industry has been taking, advantage, hopefully, because they know that they have a deficit with respect to assets and project and growth, and they need to find these lower quartile assets in this gold price environment and what's going to be working, because they can't grow at these prices if they don't find better assets, and the lack of exploration has left them their coffers bare for those kind of assets. So that hence the industry placement in junior companies, because they've basically decimated their exploration budget. This has been a theme that we've been discussing for about 2 years. Now we were seeing Australians acquire assets. We see Newmont with Galore Creek. We've seen Coeur d'Alene with Northern Empire. So we're seeing some of that acquisition happen. And some like South 32 with Arizona was all cash at a 60-odd% premium. So this is interesting that some of these, because usually when you see cash bids, then people are thinking, oh, the market's turning. But it also reflects the the fact these companies are semi-desperate, right, because they don't have anything and they need something, and this junior has it. And so we look for juniors who have these assets that we think that, wow, there's no junior that owns an asset like this. They're all in majors' hands. So eventually, maybe you should be in a major's hands, because that's exactly what they're looking for. So we're not looking for the intersections that drive the stock price up and then the next, we don't think that it's going to work.
You want it to be sustainable.
We want it to be sustainable because we want that discovery to be an actual discovery and not just a redrill.
Without asking for specific names, a brief checklist of items that are on your due diligence checklist when you're vetting a junior.
Well, I mean, let's say, in terms of, we look at management, what's their experience? Do they bring a comparative advantage to that type of asset, whether it's a copper gold asset or a gold asset in an epithermal environment versus a shear zone? And so is that their background? Are they good technical people? Because that's really what you're giving them money to do, is to explore.
In a perfect world.
Yeah, and then, the other problem is it's hard to marry the capital experience, so they're really good technically and they blow their share structure out, which we've had with the company.
Absolutely.
And then we like the people. Well, I sold that one. If we're talking about the same one. But and I could see it. And I say, well, I need your market cap to go up 20 times for me to get a double on your share price because of the way you blew out your share structure. But they don't seem to get that. Right. So they need to understand that, because that one drill hole, if you divide it by 1 billion shares, is not going to get you that kind of return.
So management, experience, a background.
And then the asset itself. Like, do you have the money to do what you're saying? What kind of catalyst should I see? How is this going to advance my knowledge of it? What should I be looking for? So that's what we try to do. So, okay, we're looking at this kind of deposit. Where are you drilling? And so which are the important holes? And what are you what's the value add here in terms of understanding? Are you just re-drilling holes? Is this infill, or are you stepping out? And what's the market interested in? And I'm thinking that the market is more interested in that step-out hole than you re-drilling a hole, because in the end, the market will understand that it's only a re-drill.
Right.
Hopefully in the end, because the other thing, the reaction will be ephemeral.
Yeah. Honest exploration.
Yeah, because if you're truly there to add value and provide us with an asymmetric risk profile, doing it that way is the best way, the only way.
Joe, I know it's late. There's a ton of people waiting on you. I appreciate you taking the time. How can people get a hold of you?
I don't give up my phone number. But yeah, it's explorationinsights.com. I don't think anybody does the www anymore. And yeah, there's a lot of free stuff there in terms of what we do. Interviews like this will be on there in terms of links. And if they want to subscribe, there's a subscribe button. We produce a weekly newsletter about the junior mining market. We talk about what we're buying, what we're selling, what we're not buying, and what we're not selling, and why. And then, basically, our focus is on the junior mining sector, and my experience is over 20 years doing exploration for little companies, but mostly big companies, doing corporate development, market analysis, and equity analysis. And Brent's has been more on the buy side and also working for exploration companies. So we bring quite a bit of experience on that side to help us and hopefully help our subscribers vet their opportunities.
Excellent. Joe Mazumdar, Exploration Insights. Thank you for your time, Joe.
Thank you.
Appreciate it.
Cheers.